Bitcoin has experienced 4 drawdowns exceeding 75% since 2011. In each case, the asset recovered to new all-time highs within 2 to 4 years. The institutions that were wiped out during these drawdowns were not victims of Bitcoin failing as an asset. They were victims of position sizing that did not account for the full range of historical outcomes. Managing crypto volatility is not about predicting when drawdowns will occur. It is about constructing positions that survive the drawdowns that will certainly occur, in magnitude and duration that historical data makes clear. This video provides the quantitative framework for doing exactly that: how to measure drawdown risk, how to size positions accordingly, and how to set rebalancing rules that prevent a crypto allocation from metastasizing into an existential portfolio risk. Bitcoin's 4 major drawdown cycles reveal a consistent pattern: dramatic peak-to-trough declines followed by complete recovery and new all-time highs. The 2011 crash from Tutu was a 94% decline. The 2013 to 2015 bear market saw Bitcoin fall from nearly 200 to 50, an 87% drawdown that lasted 3 years before full recovery. The 2017 to 2018 ICO bubble produced an 84% peak-to-trough decline. The 2021 to 2022 cycle, amplified by macroeconomic tightening and the FTX collapse, reached 77%. In each case, Bitcoin recovered fully and reached new all-time highs within 2 to 4 years of the trough. For an institution holding a 1 to 5% Bitcoin allocation, a 77% drawdown in that position translates to a 0.77 to 3.85% portfolio impact, painful but survivable. For an institution holding 25% or more, the same drawdown is potentially catastrophic. Position sizing is everything. Putting Bitcoin's drawdown profile in context with other asset classes is essential for calibrating position sizing. Bitcoin's maximum drawdown over the period is approximately 94%, comparable to Ethereum and far exceeding traditional risk assets. The Nasdaq 100, including the 2000 to 2002 dot-com collapse, reached 83% peak-to-trough. The S&P 500's worst drawdown was 57% during the 2008 financial crisis. Gold has experienced a 45% maximum drawdown. A traditional 60/40ths portfolio reached 36%. This comparison immediately suggests position sizing guardrails. An institution that size tolerates a 5% portfolio drawdown from any single asset should hold no more than 5 to 6% in Bitcoin, given its historical maximum drawdown. At a 2% portfolio drawdown tolerance from crypto, the maximum allocation is approximately 2 to 2.5%. These are not conservative estimates. They are historical facts about an asset class that has completed its full volatility distribution across 4 distinct cycles. The Kelly Criterion provides a mathematically rigorous framework for optimal position sizing given a known win rate and return distribution. Applying it to Bitcoin using historical 4-year cycle data, the probability of a positive 4-year holding period is approximately 75%, with a median gain of roughly 300%. The probability of a negative 4-year outcome is approximately 25%, with a median loss of 40 to 60%. Full Kelly on these numbers suggests an allocation of approximately 8 to 10% of a portfolio. However, institutional investors universally apply a Kelly fraction, typically 1/4 to 1/2 of full Kelly, to account for model uncertainty, fat tails, and the practical reality that Kelly maximizes long-term geometric growth at the cost of extreme short-term volatility. Quarter Kelly on Bitcoin historical data suggests a 2 to 4% allocation, which aligns with what institutional investors who have studied the historical data most carefully have arrived at independently. A practical crypto volatility management protocol for institutional investors requires 4 operational components. First, derive the maximum allocation from the portfolio drawdown tolerance. If the investment committee is willing to absorb a 4% portfolio drawdown from crypto in a worst-case scenario, and the worst-case historical crypto drawdown is 80%, the math limits the allocation to 5%. This is a hard ceiling from risk tolerance, not a target. Second, cross-check with volatility-adjusted sizing. Bitcoin's realized volatility is approximately 5 to 6 times that of US equities. If your equity risk budget corresponds to a 10% equity allocation, the volatility equivalent crypto allocation is 1.5 to 2%. Third, set rebalancing bands that prevent the allocation from drifting too far in either direction. Crypto's episodic gains can turn a 2% allocation into a 10% allocation very quickly if left unmanaged. Fourth, define drawdown circuit breakers in advance, not in the moment of maximum stress. The institutions that have navigated crypto volatility successfully share a common characteristic. They defined their risk parameters before the volatility materialized. Position size, rebalancing triggers, drawdown thresholds, and exit criteria were established in advance, documented in investment policy statements, and enforced mechanically. The institutions that failed, and the list is long, from crypto-native funds to traditional asset managers, failed because they either sized positions without reference to historical drawdown data, or they held positions through drawdowns without predefined rules for when to reduce exposure. The historical data on Bitcoin volatility is now rich enough to support rigorous quantitative risk management. 4 complete cycles, each with massive drawdowns and subsequent recoveries, provide sufficient data to calibrate distributions. The institutions treating crypto as a small, rigorously sized alternative allocation are the ones positioned to capture the long-term return premium without existential risk to the broader portfolio.